Howdy, Jacob here. Today we're looking at company 9 of our generic stock screener, ticker symbol ADEA in the software industry, 1.1 billion market cap on 1.5 billion enterprise value. Says it was incorporated in 2019, but it has data to 2014. So, yeah, what does that mean? I don't know. They operate as a media and semiconductor intellectual property licensing company, really globally. Company licensed patent portfolio, including multi-channel video programming, compromising cable, satellite telecommunication. Okay, their growth has been heavily declining since 2020, but still up from pre-COVID levels for the most part. But definitely big declines there. Gross margin, however, is 100%, so it doesn't take any cost of goods sold to produce the business. Their operating margins are pretty substantial as well, in the 30% range. So their earnings per share, though, are pretty volatile, so there must be some investments that they're making that are causing this volatile earnings per share and return on invested capital. So let's look at that quick. Income statement shows net interest income almost always negative. That's kind of interesting. Okay. I'm not sure how this gets added here. 162, 110 pre-income tax, post-income tax, negative 296. That doesn't add up at all. There might be some quickfs.net whackness going on here. Yeah. Okay, so cash flow statement shows a lot more consistency. Bless up. So depreciation and amortization are a huge portion of this business, and that's how they're able to make their net income so low. But on the free cash flow side, that really gets to tell you what is the cash coming in, what is the cash going out, and that is my free cash flow once I take into consideration capital expenditures and what I invest in. We see use of cash mainly recently paying down debt, and that debt figure is 55 million in cash on hand, 29 million short-term investments, 66 million short-term debt, 520 million long-term debt. That 500 million long-term debt in relation to their 5-year average free cash flow is probably about 3 years. So we're really not concerned with that debt figure. The company has been buying back a little bit of shares, reinvesting a little bit back in themselves, making a little bit of acquisitions, paying a little bit of a dividend. So, I mean, they're using everything that you can do. So, the most advantageous form of capital allocation is to just literally go down the list of what gives you the best return, what gives you the lowest return. And, let's say this business, 150 million is their 5-year average free cash flow. They can reinvest 50 million at a 20% return, reinvest 10 million at a 10% return, 15% return, let's say. Buy back shares that they could probably get a 13% return on for, whatever. That would be the capital allocation structure that I would be going down. But again, they're using everything, which is not necessarily bad. It's just the way it is. It's very likely not the most advantageous, as at times it's going to be more advantageous to make an efficient acquisition, may reinvest back into yourselves at a 20+% rate of return, pay a dividend when you have nothing else to do, pay down debt when you're over levered. So they're really just kind of going through the motion here. I'm sure that there is some strategy there. Every company, pays people for capital allocation purposes, but it doesn't necessarily mean they're doing the best and right thing at the right moment. Let's start making some assumptions here on the revenue growth side. I might be sticking with pretty even Steven here. I mean, maybe they grow a little bit starting now. Let's do 2, maybe 13 P margins. I'm going to probably go closer to what their free cash flow margin is. Sorry, capital 40. So maybe let's do 30, 40. Share change, 1% would be about 11 million. Offsetting stock-based compensation of about 30 million. That seems pretty reasonable. Let's do 1%. Their dividend paying out 20 million is maybe 10% of their 5-year average free cash flow, but they haven't really increased that substantially at all the last 3 years. So I think I'm comfortable with that currently where it's at. So this is just a pretty wild business. From a cash flow side, we're looking at a lot more consistency, but from a revenue and earnings standpoint, this looks absolutely crazy. So I'm kind of excited to do more research on it, and it looks like it hopefully won't be too much longer until I do further research on it. But this is definitely a weird company. I'm gonna want to do more research on it to see whether I think these are accurate or not. Obviously, I care most about free cash flow, so it's good to see that that is pretty close to the current price. But I guess I'm gonna change one thing. So there, I want to do market cap and enterprise. I want to do my P and price free cash flow more along the lines of enterprise value, and so I just diminished their P and price free cash flow based on enterprise value being about 40% greater than market cap. But even still, 37% drop sounds like a lot, but the volatility of companies throughout the year are definitely for a lot of companies out there more than 37%. So I wouldn't be very surprised to see that. But I do hope you enjoy the video, and I do hope you have a great rest of your day. So thank you.